Through today's market swings, Charles Ortel, he is Managing Director at Newport Value Partners, and David Gertz, he is Senior Vice President and Chief Investment Officer at Highmark Capital Management. Good to see you both. Charles, first to you, if I can. A lot of questions about whether you trust the financial figures. We talked to both Liz's about. Both Liz McDonald and Liz Clayman have views on that. What do you think? Do we trust these numbers? Have they boiled out all the bad stuff?
Absolutely not. I mean, I think the numbers that are out so far on a lot of the names are preliminary estimates. We're only beginning to get, for example, we have not yet gotten for GE their actual 10Q. So to understand these very complex companies, you really have to have some time to consider hundreds of pages of filings and think carefully about them. And I think right now these financial stocks are trading more on hype and hope than they are on, realistic evaluation of numbers.
And folks, you should know that Charles actually recommended that investors short GE, and that was back when it was what, $38?
August 31, 2007.
He remembers because he was so right.
We actually recommended buying the credit default swaps at 40, shorting the stock at 38.87, shorting insurance companies, Moody's, regional banks, and putting a call option trade on physical gold at 665.
David, obviously, people have misses and wins here, but what's your win at the moment? What are we looking forward to when it comes to investing our hard-earned dollars with this frightening atmosphere out there that a lot of people are more willing to sit on the sidelines and watch?
Well, there is a lot of concern that individuals have about it. Begins with the economy and extends right on through business. And I think we're in a very interesting period of time today when we have this massive stimulus that's been in the pipeline really since October. And when we think about Fed policy and how long it takes to translate into markets, and as we've started to see the emerging markets start to come back, that the real seeds of this recovery and this credit crisis is starting to take hold. I think for Highmark investors, we've been very clear to point out that it is the seeds of this credit crisis that is so key to what's happened in terms of the acceleration in the recession. And that as we look forward, if we can get credit flowing again, that there is hope that we could see a rebound in the economy, probably mid-year. We're starting to see a stabilization in housing. We saw that with the National Association of Realtors a couple of weeks ago, and the latest report just reaffirms that. So I think we're starting to see the signs of credit moving, low-cost credit, mortgages starting to pick up, and all of these are good indicators of what we think.
I think we may have a debate here because, Charles, I don't think you quite agree with that. You do something interesting, which is to divide the economy in three parts. The public sector, which is growing by the minute, the multinational corporations that we were talking about at the beginning, and then the rest of the private sector. And that's the backbone of our economy, and that's the sector that's hurting most.
I would characterize in the U.S. the government policy as basically being schizophrenic. We're pushing the cost of labor up just at the moment in time where labor around the world is accessible at low rates. We have a massive amount of debt in this country and in the advanced economies around the world, way higher than it should be in relation to the private sector economy. We're, I would argue, waging an unintended war on capitalism right now. We need to encourage capital formation. We do not need to demonize profit making. We need to make this country really attractive for investors around the world.
Yeah, but not attractive for fraud and disaster, the likes of which we have seen develop over the past 8 months.
I come at this actually from the right side of the spectrum, and I am appalled by the system of regulation, particularly in the United States. I think the SEC does not have the resources it needs to actually sniff these problems out and punish people. I think there's a mismatch between incentives and punishments in the way the system is run, and the people in the SEC seem not to be terribly numerate.
So, David, do you think that the government is now focused on getting regulations to the point where they can really hit the toxic aspects of our economy, not the productive aspects of it?
Well, I think what's important as we move forward with regulation is, first of all, we deal with the issue of enforcement. Obviously, there was some lax enforcement in terms of regulation, and that really has been a chief concern. There's plenty of laws on the books, and I don't think anybody in the financial industry is going to tell you that our costs have been going down in terms of managing regulation. But it is important to do smart regulation, and investors need to have confidence in markets, and the two go hand in hand, I think, as we think about regulation going forward.
David Gertz and Charles Ortel, great to have you both. You're welcome again. We'd love your perspective. Thank you.
Really good discussion.
Well, if